again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is May 16th. It's a Tuesday. We're going to talk about the three topics, moving markets, and a lot more. So thanks for watching, and let's get right to it. So our three topics, moving markets. This is Fed Week. We got a lot of Fed governors out there basically talking their book. So we're going to pay attention as it always moves markets one way or another. And the second topic that's basically the cloud over the market for the next week, week and a half, or even 2 weeks is the debt ceiling showdown. We'll talk about that today, as well as some key economic data that the Fed is also going to have to digest as they are data dependent. And finally, we'll end today with a major losing streak broken. It's kind of interesting in our research that we've discovered, sort of an interesting fact that I think we all want to pay attention to. But let's get right to it. So this is a chart in our morning research that we talked about, and maybe you can see it here, is basically the post-recession. The government always steps in, and this is going back to 1970s, and this is showing post-recessions dating back to 1970s. The U.S. government traditionally steps in to basically bridge the gap of what the consumer is pulling back on in terms of consumption. That's where, historically speaking, even though you see signs of a recession, from an investor standpoint, the economy can still keep growing, or growing, if you will, because the government always steps in. Now, historically, it hasn't been, it's been enough to sufficiently propel or fill the gap of the consumer pulling back on the reins. Call it 2008, 2001, 1990, 1980s. For the chart purposes, there was two dips in there, two recessions. So this has been combined even with the government in both of those cases. And then the early 70s, this 1970, 1973. But the standout here, obviously, and I think what's important to understand, is the 2020 spending, the trillions of dollars, $5+ trillion just by the government assistance because of the post-COVID scenario. So what does that mean? Ultimately, that's the problem that the Fed has been working with, is that there's too much money out there by M2 money supplies for the consumer, for businesses, simply because the government basically overshot the runway with regards to handing out all of the stimulus, because they didn't know what the ultimate sort of net economic impact would be of COVID. And clearly, we're dealing with, the Federal Reserve has to, and we as in consumers, when you have too many dollars chasing too few goods and services. Obviously, it was goods in the first few, year and a half, 2 years coming out of COVID. Now it's services, right? Anywhere from airlines to hotels, everything else. The consumer's still healthy. We're going to talk about that. But more importantly, all of this money is basically following through and funneling through the economy right now. And that's really the major inflationary issue and pressure that we're dealing with. Another key component that the Federal Reserve is going to be, we're going to be paying attention to see if in any of this Fed speak this week, this is what they're talking about, which is the median wage growth. And so we've talked about the tightness in the labor market, but also for wages, is the inflation, which is entrenched in balance sheets, if you will, if you're a small business owner, to anyone who's looking for talent out there. But we're actually seeing, according to the Atlanta Fed median year-over-year tracker, that the wage inflation is coming down. So we're seeing pressures sort of abating, if you will, on sort of that wage inflation. And that's the key component to keep the Fed either on a pause, higher for longer strategy, which we believe that's the case, and more data dependent. So there's going to be a lot more data between now and the next Fed meeting. But let's talk about the data. The U.S. economy, retail sales rose 0.4% in April, but less than expected as consumers struggle with inflation. If you see some of the reports from some of the big box retailers, consumers are pulling back, and there's several reasons for that. There's obviously the U.S. debt crisis, the debates that are going on right now, but even pushed back a few months earlier, we have obviously all the small and regional banks that are adding to what the Fed has done, raising rates, right, 10 times to 5% to 5.25% in terms of Fed funds rate. So putting the brakes on the economy, but also continuing to tighten by way of regional and small regional banks, sort of battening down the hatches, holding on to reserves as best as possible. And ultimately, that's going to lead to a less of a lending aspect moving forward. So the consumer's pulling back a little bit, and we're seeing that. And then the liquidity that the Fed was kind of hoping for is now, because of the banking crisis, tightening up as well. And that's all going to slow down the U.S. economy. But this is another look at, ultimately, we just talked about the U.S. retail sales and nominal year-over-year change, and it's slowing. It's the slowest since May of 2020. And then retail sales, and adjusted for inflation, again, it's another positive trend. So let's see what the Fed speak is. But if they're data dependent, a lot of it's moving in the Fed's way to ultimately slow the economy. Now let's talk about the major losing streak that has been broken. This is a great piece from Strategist. And let me read this to you. The S&P has just broken a streak of 12 consecutive months with negative rolling 12-month price returns. This historically is very rare, which means that month over month, the trailing 12 of the S&P 500 as an indices has been negative. And now it just turned positive for the first time. And this is meaningful simply because if we then look at the consecutive months with rolling negative 12-month returns, just from the analogs or the streaks going back to 1947, 58, 63, 70, all the way through, if we look at how the market has sort of responded since then, I'll go to the next slide and we'll talk about this. This is basically the month streaks that ended the preceding, basically forward 12-month performance. So if we go back to looking historically speaking, back in the basically 1947, 58, 63, 70, 75, 78, 82, 03, and 09, when that streak has been broken and it has just concluded again. This is the 12th month here in April of 23. What is the forward PE or the forward total return on the S&P 500 from this point forward look like? We don't know. However, historically speaking, it's set up to be pretty good. Back in the 40s, it was 2.5%, so they had modest growth, but a positive on the S&P 500. And 1958 was 24.8%, 13%, 10%, just under 10% again. So these are all positive sort of setups, which means as the S&P 500 sort of predicts what's going to happen, even though the economies could go in recession, and clearly that doesn't mean that the markets have to go down. In fact, the markets bottom before we actually sort of get out of a recession. And one of the things that we have been reading in Research Wall Street Journal from Bloomberg and everywhere else is that there's also now talk about what could be rolling recessions and rolling corrections. Now, what that means is, think about it, the S&P 500 is segmented into 11 sectors, from real estate to utilities to defense and financials and obviously technology. But each one of those has sort of a different leadership positions. Even energy. Energy was great last year. It's lagging this year. Technology was lagging last year, and technology is doing great this year. It's the leader. So that diversification, as we see rolling corrections through some of the segments or the sectors of the economy, i.e. the market, that's the resiliency that we're seeing hold up the S&P 500, even from a price standpoint. But again, we keep an eye on the consumer because 2/3 of the economy is U.S. consumer. They're slowing down. And then the small business owners are being more conservative. That could set up to a slowing of the GDP. And if we hit a recession, what we've learned earlier in this conversation today is that the government can step up and ultimately bridge that gap. But that's far down the road. We have to get through the debt ceiling discussions. We're going to have more conversation on that. I think it's still too early to say right now that showdown is going to continue to persist in our headlines. So I'll talk about that more later this week. And as we get closer, how we're set up from a portfolio positioning standpoint and how we can navigate the volatility as well. That's our update for today. Thanks for watching. Again, like and subscribe and share with friends and family. We appreciate it. Take care.